MHFA released their first generation down payment assistance program, offering buyers up to $35,000 towards the purchase of their first home. Here's how big that is. Let's say you need $36,000 to buy the house. You apply this $35,000, leaves you with $1,000 that you need to pay in order to get into the home. This product is only for first-time buyers who are also first-generation home buyers. We'll talk about all of that and how to determine if this applies to you in this video today. We'll talk about how it works, how to qualify, and also how to get it. Hey, I'm Peter Lindquist with the Lindquist Team. You know, I've been doing this for 32 years with a special focus on first-time home buyers and down payment assistance. If you like this video, you know, please give it a thumbs up. Just click that little thumb below. And if you've got any questions or comments, feel free to leave them in the comments below. I'll be sure to get back to you. And then also consider subscribing to our channel. You know, I talk a lot about down payment assistance and first-time home buyer programs in general. So whether you're a home buyer or a realtor, or you just want to know information like this, please consider subscribing. So this $35,000, you can use it towards down payment and closing costs. And quite literally get this down to about $1,000. MHFA, all they require for you to put into the transaction is $1,000. So it makes it very affordable to buy a home. It's also forgivable. That means this is a loan, it's not a grant. It's a forgivable loan. It's forgiven under two circumstances. One is if you live in and occupy the property for 20 years and still have this loan, it then becomes zero. Or they also have a provision at 10 years. So if you've lived there for 10 years, then it's cut in half. So this does not mean you have to live in the home for those periods of time, but it does mean that it becomes forgivable to those extents in that time frame. While you have the loan, it's a 0% interest rate. So it's just sitting there, it's not growing because there's zero interest added to it. And best of all, there's no monthly payments on it. It actually helps reduce your monthly payment because your first mortgage, which has the higher interest rate, is lower than it otherwise would be because of the down payment assistance. This is not a standalone product. That means that you have to get it with an MHFA first mortgage. They offer, you know, conventional, FHA, VA, and USDA. It has to be one of those in order to get this first generation down payment assistance program loans. It becomes due and payable under three circumstances. One is if you sell the home, you need to pay it off unless it's 20 years from now and then it'll be gone. Or if you refinance the first mortgage, it has to be an MHFA first mortgage in order to keep this loan. So if you refinance to another type of loan, then it becomes due and payable. So if it's a traditional Fannie and Freddie loan or FHA or what have you, you would either need to pay it off or combine it into your new first mortgage. But if it's an MHFA new first mortgage, that's fine, so you can keep it. The third one is a big one, and that is if you vacate the house and rent it out. If that happens, then it becomes due and payable right away. And people ask me, well, how would MHFA even know? Well, it's change of address, forms that MHFA will find out, and then it becomes due and payable right away. This is a loan that is only for owner-occupied buyers. You can't be an investor to get this loan. You can't buy it and then with the intent that you're going to grow a real estate empire and rent it out and go on to the next one, because the $35,000 comes due. Now, one of the best features to this loan is you can layer it with other down payment assistance programs, including with MHFA. MHFA will allow you to get two of their down payment assistance programs at the same time, only if one of them is the first generation program. If you qualify for this, you could also potentially qualify for their deferred payment loan or their programs that are $16,500 or $18,000. I've got videos on both of that. I'll put those links in the description below, but those are also 0% interest. Pretty soon it's adding up to serious money. You've got $35,000, potentially another $18,000, that's $53,000. And you're making no payments on these. Now, on top of that, many communities around the Twin Cities have their own down payment assistance programs. Some are $10,000, some are $30,000. So if you got one that was $30,000 and you add that to the first generation loan and the deferred payment loan, you could get a total of $83,000 of down payment assistance from MHFA and community loans. So pretty soon, you know, we're talking real money. So how to qualify? Well, at least one buyer has to be a first generation home buyer. If there's two people on the loan, at least one has to be a first generation home buyer. The other one just needs to be a first time home buyer. With this program, first time home buyer is defined a little differently than some programs. With this one, you can never have owned a home in the past. With most other programs, you're considered a first time home buyer if you haven't owned a home in the last 3 years. But this program is you've never owned a home. So what makes it first generation is if your parents have never owned a home also, and that includes any country. So not only do you have to be a first-time home buyer, but your parents need to have never owned a home also. Now there's a couple of caveats to that. If your parents lost their home to foreclosure and have not owned a home since, then you'd be considered a first-time home buyer. Or if you aged out of foster care, or if you were emancipated when you were younger, in all of these cases, you would be considered a first generation home buyer. Now, one big question people have is, are my parents involved, or, you know, do I have to get a letter from them? No. This is all based on your testimony. You're signing a legal document that's called a borrower attestation, and you're attesting to this as fact that you are a first generation home buyer. So how do you qualify? Well, there are maximum income limits because this is a needs-based program. There's no maximum asset limits like would be on the deferred payment loan. Now, if you are layering this with another down payment assistance program that has more restrictive guidelines, we're going to have to use the most restrictive guidelines for any of the programs that you are using in conjunction with this program. This program really is pretty limited in terms of what it requires from you. And they have this thing called a housing ratio that has to be at least 28%. Let me give you a couple of examples on what that means. If your gross income is $7,000 a month, that's $84,000 a year, then 7,000 times 28% is $1,960. That means the new house payment has to be at least that or higher in order for you to qualify for this program. Again, because it's needs-based, it's trying to make an otherwise unaffordable home more affordable for the first generation home buyer. And conversely, you know, if you earn $10,000 a month and your new housing payment is $2,200, that $2,200 is only 22% of $10,000, and you wouldn't qualify for the program because of your housing ratio, which has to be at least 28% of your gross income. So speaking of income, what is the maximum income guidelines? Well, they're the same as the MHFA startup program. I'll put a link in the description below to the MHFA website where it shows these income limits. Income is broken down by geography, 3 different geographies. There's the Twin Cities, Dodge and Olmsted County, and then all other counties. And it's also broken down by number of people in the household. So there's 2 or less, and then there's 3 or more. And just for an example, in the Twin Cities area, 2 or less, that maximum income is $124,200, and if it's 3 or more, $142,800. Now that income needs to count the first generation homebuyer plus their legal spouse, even if they're not on the loan. So if you and your legal spouse earn less than $124,200 and it's just you two in the household, now you qualify. So now let's talk about how to get it. The first one might seem obvious, but it's not. And that is, you have to talk to a lender who actually offers it. Not all lenders offer financing from Minnesota Housing Finance Agency. And even if they do, they don't necessarily offer all their down payment assistance programs. I do. The company I work for offers that, otherwise I wouldn't be talking with you. And the other thing to know is you need to get the first generation down payment assistance loan with whoever is doing the first mortgage on your loans. So you can't be doing a loan with XYZ company and then come to me and just get the down payment assistance loan. You're going to have to get both those loans from one lender, which I hope is me. Now, speaking of that, how do you apply for this? Well, in the description below, I've put links for how to apply online, or you can download my app so you can apply right on your phone. And then by applying, I'm able to see what your income, assets, and debts and your credit in order to see what you might qualify to. A key point here is that we only do a soft credit inquiry. That means when you apply for pre-approval through me, there's no cost, no obligation, and no impact to your credit score because we use a soft credit inquiry. We get all the information that we need right from that credit report in order to tell you whether you're pre-approved or not. Now, once you find a home, eventually we need to pull a hard credit report, but up until that point, no cost. There's no damage to your credit. It doesn't even show up as an inquiry on your credit report. All right, I'm Peter Lindquist, and with the Lindquist team, I want to thank you for taking the time to be with me. If you've got any other questions or comments, please leave them in the comments below. Thanks for taking the time, and have a great day.